All right. Good afternoon, everybody. Chris Lester here. This is a recap, sort of, always rear view looking. I call it rear mirror syndrome. So, it's just like watching NFL football on, Sunday when the action's happening. It's very, you're tense. You don't know maybe if you would have done something different. But on Monday, everybody's an expert, right? So, you know, part of what I try and do here is take our focus off of where we are right here today, but make sure that we have some sort of forecasting, for the future on how things look. So these charts, and also my back room, my tech services at Brookstone have started to use wide charts. So some of the charts are a little bit different, and I'll go through those as we get started. All right, so this is a month to month, right? So August, it's a snapshot from the beginning of August 1st or July 31st, all the way up until the end, August 30th. And you'll see that there's different colors. Obviously, most of you don't need me to read every one of these to you, but the next slide will be a little bit more telling. What I do want to say, if you have a 401k, you probably felt the pressures of August, right? There's an old saying, sell in May, go away, right? And that may very well be true because September historically has been a very difficult month, and we may see some volatility, although today was a little bit of a rally. Right. So, as we look at August, heading into, the fall, which is what this data is dictating, again, the equities markets across all spectrums were felt a little bit of pressure. Right. So, but for the year, things actually, it's a little bit more soothing. Obviously the S&P is really been the leader, and we're going to see some up and downs, because if you see in March, it was right in the middle of the pack and it has started to break out. It would not surprise me to see by October, November, December, January, first quarter of 2024, start to see a reversal there. There's a lot of pressure, but again, some of the news that came out today was promising. So this is why, I just did an interview yesterday, and one of the questions I was asked is, does market timing work? And the answer is a resounding no, right? We cannot, just sit back and try and pick when we think we should get in. If we're getting bonuses, if we have some a windfall of cash, taking money and dumping it in, and then or sitting in cash and saying, okay, I think the bottom is falling out. I have seen many studies, and none of them have ever said that that's a good strategy. So, I just being consistent, having a strategy, having a plan is prudent. And then, we can see that both the purple here, which is the S&P, and then the green, which is developed countries. This is European countries, right? So that second one, that usually is a sort of the heartbeat of the economy. So I think right now things look good overall for the year. And then, so 2023, and as I said at the beginning of this year, it wasn't until Q3, Q4 of 2023 that I think we will start to see some continued pressure. But right now, still clear sailing right now. I hope I don't get egg on my face today, tomorrow, next week, because that's always the risk. The markets go up and go down, but there's nothing, bar some global event that I see that's jarring right now. Now, this is one of the new charts I talked about. The old one was, all the way back to 2000. And what they did was they shortened the time frame, but it's all the same basic data, right? But in a smaller snippet, and it might help us to better understand right around where we are now, right? So there's three indicators. There's the top one is a moving average indicator, and it's a 3-month, 12-month. And again, we had a green line earlier this year. That means that things look like they will continue to rise. This is, three indicators when you're using technical trading. It's just you have to use some benchmarks, and some people use this. So this is by no means an end all be all absolute, but it's just some guidance to help us to make good decisions. The RSI, the relative strength index, is really sort of a speedometer, how quickly things are moving from an indicator. And typically, if it's above 70, things are oversold, and if it's below 30, they're overbought, and that's what that red line, green line means. So we're right in the channel. So there's really nothing here that's pressing or alarming right now. And then the last one is a MACD, or moving average convergence divergence. And this is, again, is another indicator that is just showing momentum and trends, right? We're starting to look at trends. And I learned a long time ago, you never buck a trend, right? So as much as, you may think that something is going to go in another direction. I learned one time when I went to Atlantic City, you walk by, and I don't gamble a lot, but, roulette, they have those big signs, and you're looking at it and you're going, that wheel has hit red 15 times in a row. It can't possibly hit a 16th or 17th or 18th. And you know what? I've lost money with that philosophy. And that's where I learned a long time ago, when I was first able to legally gamble in New Jersey, not to buck a trend, because somebody said, oh, I got a system. And they said, all you do is you press your bets and you double up. And I'm like, you know what? I'm not cut out for that. So, that sort of, think of the MACD is as a trend betting indicator. So overall, we have a green line. Things still look good in the equities market. So, and again, it is a little bit of a different chart, and we will continue to build on it as we go forward. Now, the next one, this is the bonds, the income portfolios, fixed income. And again, this is an area where, nothing to write home about for the month of August. Everything was under pressure or very minimal returns. But as we look at the year, I think that the only one that is down is the 20-year treasury. Everything else was above zero. And, this gold here, if you look at it, this is high yield corporate bonds. And I've talked about this before. People are pushing, in a rising interest rates. We're starting to see, interest rates start to settle back into some semblance of normality after being so depressed for at least a decade. And the challenge that we will have here is finding that balance. But as people are chasing return, I'm always cautious as to where you put your money when we're talking about bonds, right? If we're going to be in bonds, when you see that word high yield, substitute those words high yield for junk, right? Those are junk bonds. And by name, right, that sort of dictates to us, be careful, right? That when you're buying less than creditworthy debt from a corporation, you could end up finding being on the wrong side of that bet. So, nothing alarming here, but again, it's just, if you're in a fixed income need, or if you're looking at your portfolio to generate revenue, having diversification. And, I was a little slow for bonds for about the last decade. I'm okay with having some of our money in some type of bond holdings, and whether those be US or whether they be international European marketplace, I'm okay with most of what's up here. I just where I get cautious is when I see those high yields, and high yields typically, like I said, can be above average risk for most people. They're just not aware. All right, so the triple cross are the three Wiseman indicators here. Again, we have a green line, right? So the only indicator here that started to cause me a little concern was this top one. Now, when one crosses over, it doesn't go red, but it's just telling you that this red line right here is about to cross over. So we may very well see that by next year, that this is below, right? Notice that when this crossed over, this blue is when we got that this indicator was above, this indicator was above, this indicator, which gave us a green line. Once one of these crosses over, if we get 2 or 3 of these crossing over, we may see back to a red line again. So, it's not an albeit, end all be all, but it will help us to have some guidance. And if you're into, piloting a ship or navigating an aircraft, nautical terms, aerial terms are, we have gauges on our boat or on our in our cockpit, right, that we're looking at to give us an indication of what's coming down the pike, right? So if I see storm clouds on my radar, or if I'm getting, chatter over the radio that there's 10 to 12s out there, seas, I can tell you I'm not running into that storm. That's just me. That's how I was raised. I try and say I can circumvent that. I don't need to take it on the chin to go, oh, I guess they were right. It's one thing to get caught in it. It's a completely another to run into the teeth of the dragon, as we like to say. So that being said, the last one is, this is a new version of the indicator that Formula Folio has created. And now Mark has pulled this data from Y chart. So it's not as extreme as we were showing the 84, 85, but it's still showing that 66% probability, right? That calculates 12-month for probability of having a recession. It's pretty high, right? So it just, don't get caught off guard. Don't get complacent. We all see the telltale signs. We got rising gas prices, rising food prices. There's some inventory is started to become scarce, right? I see news articles all the time on TV when I'm watching some of these things. This is out, this is out. But again, we got good news today. So my purpose of these calls is not gloom and doom. My purpose is just sort of really, like I said, being a rear view mirror expert, looking at things and saying, hey, what happened in August? Now that we're sort of past this, can we make any type of adjustments on a go forward? I've been cautioning this year, careful of the equities and the bond markets as we go forward. We have to invest somewhere, but going out there and saying, hey, I did get a bonus, and you know what, market's good, I don't believe it, and dump it all on red like you're in Atlantic City could be a huge mistake. But if you're in some type of retirement plan at work, if you have the ability to dollar cost average, there's prudence in that, and we strongly encourage that. So before I get to this last slide, we're pretty much done. I do want to say that this is our last call for the next 4 weeks. I am absolutely full throttle now this fall. So I am in Kentucky, I'm in Chicago, I'm in Vegas, I'm in Scottsdale, 3 days out of every week for the next 4 weeks. So our next call will be an October review of September. So I want to wish all of you a great day. I continue to thank you for taking time out of your busy schedules to come listen to what I have to share. I will continue to try and bring value every day. And if you need me, I'm always a phone call away. So thank you all, and talk soon.